maybe I want to tell people how we manage money and why it's important when you're facing. So now we've just kind of talked about this for, what's happening in the US, what's happening in Canada, what's going to happen to the dollar, where we're sitting at. But I want to talk about what we're advising our clients with respect to their own risk tolerance and how they feel about their portfolio. And maybe I'll just start by making a statement here. My belief as a portfolio manager is as a fiduciary and a steward of your wealth. So my job is to protect your wealth and to make sure I'm building a portfolio that you can sleep at night, you, the client, can sleep at night. And we're getting, as many tax efficient returns as we can based on that. So you guys know I've talked about this at length in the past. I believe that we should own alternative assets. I believe that we shouldn't just own stocks. I believe that we should own some private debt, some fixed income, some private real estate, some infrastructure, some farmland. Diversify as best we can so that if something does happen with the stock market specifically, we have real diversification, right? Real diversification is when an asset class doesn't move lockstep with another. So if you own Canadian stocks and US stocks, you might think you're diversified, but you're not really, because if the S&P is down 30%, the TSX is going to be down close to 30%. So that's not real diversification. Real diversification is uncorrelated performance of different asset classes. So if you own some alternatives, some stocks, and the stocks are up 30, the alternatives are going to be up there 8 or 9 or 10 or 11 or whatever they do. And if the market's down 30, they should do about the same, right? Regardless, 8 or 9 or 10 or 11. That's real diversification. And that's what we preach. So backing the truck up here with respect to this volatility, my belief is that this is a long soliloquy, eh? Sorry, Adam. I will let you speak at some point here. My belief is that you should not make asset allocation changes to your portfolio on a hunch, or in a way to try to time the market, or in a way to try to think, you shouldn't do that. Your asset allocation should be your asset allocation. And there's a reason that it should be your asset allocation, because that's your risk tolerance. That's what you're able to handle. And that's kind of what your life has taught you about investment. So when you become a client of ours, we take you through that. We look at what you own, we look at, and we adjust and we build an asset allocation model for you, on a custom basis. So if you are unhappy and you're not sleeping at night and you're starting to have impacts on your health with respect to your tolerance for risk, then that is a reason to change your asset allocation. Unequivocally, we should change your asset allocation. You need to call us and tell us how you feel if you're a client. But if you're just trying to time the market and do it on a hunch, that's a bad idea. That's a bad idea to say something like, you know what, these tariffs, I think I'm going to go all cash, or partly cash, or I'm going to sell my growth stocks, or I'm going to load up on whatever. Like those ideas, they don't work, period. I've been doing this a long time. You've been doing this a long time. We know that human emotions get in the way, and that becomes a portfolio where someone's, next thing you know, they're out of the market for a year or 2 or 3 because they've made the wrong call. Now what? How do you get back in? So it's not what we preach. It's not what we believe in. Do you have a comment on that, Adam?
No, I definitely agree. If you are uncomfortable, like you said, if you're having trouble sleeping because you're worried about the market, that might be a reason to change your asset allocation. Maybe your risk tolerance isn't quite as high as it was, when you first invested. Maybe something,
and that's okay.
And that's
fine,
okay.
Yeah.
So that is a reason to change your asset allocation. But trying to time the market, trying to time equity markets and buy at the low is nearly impossible. And I would say the same thing, Rob, with regards to currencies, right? Like, there's a lot of talk about the strength of the US dollar and worry around the strength of the Canadian dollar. But like we were talking about before, there is kind of a floor underneath the Canadian dollar, and these things are very, very difficult, and it's very dangerous to try to time them. So, I would say don't try to time the equity market, but also don't try to time the currency markets.
Yeah. So what do we do with respect to currency for our clients? And I mean, we've talked about, if you're a client, you probably know, we believe that although we do believe that there's a risk that the Canadian dollar, gets further negative pressure. We think that's a very real risk. We also believe it's possible that the purchasing power parity equation evens itself out, right? So there's two there's two pressures at bay here working on the portfolio. And it's our job to monitor that, to figure out, okay, does client need Canadian dollars or US dollars in their life? First off, right? Are they living in Canadian dollars? They're living in Canadian dollars, right? Well, that's our barometer to start with, right? So yes, we want to own US equities. Absolutely, we want to own US equities for a portion of your wealth, but there may also be a portion of Canadian equities too, right? For income, Canadian income, US income. So I guess the answer is everyone's different, but we definitely, it's part of what we do, right? We will manage that. So if there's an extreme oversold correction on the Canadian dollar where we think we're way out of whack, we will make a play or a trade to benefit our clients. And if it's the reverse is happening, right? The Canadian dollar is extremely overbought, we would do the same thing. So did I phrase that properly, do you think?
No, I think that's a good way to put it. And I would also point out that, you know, most of the companies that we invest in, whether or not they're in the US or the Canadian companies, are global companies, or they're participating, you know, in global markets where, you know, a lot of their revenues are going to be in other currencies. And, you know, that is going to support their stock price, because as they're translated, their expenses are in Canadian dollars and revenues in American dollars. Any weakness in the Canadian dollar is going to increase their profits when they repatriate that currency, right? And so it's going to support their profits, and it's going to support, you know, their share prices. So you have a little bit of a natural hedge by investing in these global companies as well.
Yeah, and for every piece I see telling me on BNN that you need to stay away from Canadian investments, there's another one by, you know, some sort of investment guru that's saying now's the time to buy in Canadian investments because they're undervalued. So remember that what you are reading, right? What you're reading in the media is click baiting, right? They're trying to get you to read the article. They're trying to get you to watch the video or whatever they're trying to do. So take that with a grain of salt, right? If there's no, like, what are they trying to sell me here? And then I would be careful to form an opinion based on that.
Yeah, I mean, everybody has their perspective, and everybody is running their own strategy, right? And so sometimes those people are talking their book, you know, talking up the way they're invested. But I think, you know, it's more important to just focus on, like you said, diversification across markets and economies. But, you know, we also try to have diversification by, you know, having multiple sources of return, especially in your equity portfolio, right? Things like being invested in semiconductors has worked out really well over the last couple of years. The GLP-1 drugs, you know, that are being developed to combat obesity in the States, that's another, you know, source of return. Increased defense spending, those are all sources of returns that are fairly well diversified from each other. You know, that you know, I think is going to protect you in the long run.